I mean, we should, of course, say the South African government can't control the global oil price. Let's use one example. But that doesn't mean that we can't make the correct policy choices that puts us on a better footing.
Inflation is on the rise in South Africa. In March, inflation hit 5.9%. That's up from 5.7% in February. And that marks the 11th consecutive month in which inflation was above the median point of the South African Reserve Bank's target band of between 3% and 6%. Joining me to discuss is Chris Hattingh. He is with the Institute of Race Relations. So Chris, what are the origins of South Africa's inflation story? What is happening locally that is driving up prices?
Thanks, David. For those South Africans who might be sitting in darkness as they try and watch parts of this video, a big factor is rolling blackouts due to Eskom's inability to keep consistent, cheap electricity supply going. That's a big driving factor in inflation. There's also supply chain constraints, which of course tie South Africa into the rest of the world. We have lots of inefficiencies in terms of our port performance, in terms of railways. We know, of course, that as the railways have declined, that has put more freight trucking onto the roads. And as road quality declines, the cost of moving your goods across roads also increases, which again filters down into prices on store shelves and that sort of thing. As a broader point, we have economic monetary policy by different governments around the world. Now, the South African Reserve Bank has managed to resist, I think, some of the worst temptations of making money printers go brr too fast and too quickly. But that being said, there has been a lot of stimulus the last 2 years as government has tried to, on one hand, counter some of the negative effects of its lockdown policies. It has tried to provide assistance to citizens, but when you print more money and when supply chains are negatively affected, when there isn't as much economic activity, then you see a decline in terms of how far people's money goes. It doesn't help just giving people grants when there isn't that real organic economic activity, the production of goods, manufacturing, that sort of thing happening. Then you have more money sort of swishing around in the system, but it's not actually directly related to economic activity as such going on. It's simply because the governments are trying to stimulate by making sure that there's more money in the economy.
And Chris, you've been quite a vocal critic of localization policies, which are being driven by the Department of Trade, Industry and Competition. Do you think that this push towards localization is also potentially driving up prices, making South African producers less competitive?
Absolutely. So while localization master plans might be noble in their intent in terms of reindustrializing South Africa, in terms of re-upping our manufacturing capacity, I think the basic low-hanging structural problems in South Africa's trade and electricity spaces make it impossible that any of those ostensible benefits of localization would actually occur. So again, going back to something like port inefficiency or railways not even existing anymore, so your goods can't be transported. So government can implement different localization plans. It can provide subsidies for locally manufactured goods. It can impose higher tariffs on imported goods, all with the goal of stimulating local production and encouraging people to quote unquote buy local. But while you have those structural issues sort of gumming up the works, it doesn't matter regardless. You can provide as much protection and subsidies as you want, but that doesn't mean that actual manufacturing capacity gets increased. It doesn't mean, for example, that electricity supply becomes more reliable or cheaper. And that, of course, affects actual manufacturing capacity and production. So it doesn't mean just because you designate certain products for local production that you make sure the broader environment in your country is conducive to business operations, to trade, to the movement of goods and services. When you have problems, so for example, again, in terms of inefficiencies in roads and ports, when you have inconsistent electricity, when you have security issues, when you have an inability by municipalities and national government to respond to natural disasters, such as the flooding in KZN, all of that brings about an environment where the costs of operating businesses is higher. Now, businesses have to factor those costs into their production, into their manufacturing. And again, that all filters down into the costs and prices of consumer goods. So when you go to the shops maybe, and you want to buy some bread and milk, all of these factors are contributing to the higher amount that you pay when you get to the till and you want to pay for those goods that are vitally important for your family.
So, Chris, this is not just a South African story. You mentioned bread prices there. And as we pointed out in our risk alert of Monday morning, wheat prices have gone up by 77% since July 2021. And corn prices also gone up by about 26% over the same time period. Those are at record highs. So that's in terms of global soft commodities markets. Germany is also experiencing inflation. Many countries in Africa are going to be very sensitive to food price dynamics that could trigger civil unrest concerns in those countries. If you think back to Tunisia in 2011, food prices are what triggered the Arab Spring. So do you think that there's some broader risks here globally arising from this rise in prices that we're seeing all over the world?
Right. So the two biggest factors at the moment would be the Russian invasion of Ukraine, of course, with Russia and Ukraine being big exporters to the Middle East and to other African countries that will negatively affect those countries. And then you have rising oil prices around the world, again, tied to possible sanctions, which have now been imposed on Russia, which affects Russia's ability to export oil to Europe and other places. That means countries have to look elsewhere to fulfill their oil needs, and where they're going to get them from. Maybe they'll arrange other deals. But until those are in place, there's uncertainty and issues around actual supply. And that, again, businesses, corporates, mom and pop shops, everyone, just, think of any business around you that economic activity, they have to factor in these uncertainties. Another problem I would say in terms of just getting goods to countries is global supply chains still being negatively affected by lockdowns in China. So China's zero COVID policy means that Shanghai especially has been under stricter lockdowns of late. Now that will all filter into supply chains around the world, which affects how cargo ships move, which affects how quickly they can load goods onto those ships and unload them at other ports. All of that sort of acts together to still keep the lingering effects of the last 2 years of lockdowns and the pandemic going. And those countries, I think, that can have a bit more of a conducive environment to goods coming in and going out will do a bit better. It's when we should of course say the South African government can't control the global oil price. Let's use one example, but that doesn't mean that we can't make the correct policy choices that puts us on a better footing. Again, this is tied to our inability to export as much as we should, where we could have benefited much more from the commodities boom of late. That would have put us in a stronger fiscal position. So you can't protect, and government shouldn't try and protect ad nauseum businesses and consumers from every global event and global force, but you can at least empower your citizens and businesses to be on a better footing if you have that sort of environment in place where it's fairly predictable to run your business, to not have high costs imposed by your own government. Then at least you can deal with other global factors affecting you, and hopefully down the line you make sure then that some of the prices of goods and services are lower, especially for lower to middle income consumers.
So Chris, finally, you mentioned monetary policy. How do you think the Reserve Bank of South Africa is going to respond in terms of interest rates? Do you foresee a hike in interest rates in the future?
Yes, very much so. I do think that because of what is likely to be tighter US monetary policy over the next few months, that'll affect emerging market currencies, and most notably the Rand. So the Rand is quite vulnerable to that. I do think that the Reserve Bank's Monetary Policy Committee is likely to raise the interest rate by 25 basis points at each of the next upcoming meetings, at least through March 2023. And that'll, of course, negatively affect economic growth. So any projections of growth higher than maybe 2.3, sort of 2.5%, or maybe a bit ambitious, I think we'll probably be stuck around 1.8 to 2.1% growth for the next while. And we've had talks of structural reform changes, that sort of thing, but those are all tinkering at the margins. I don't think we're seeing those deeper reforms in terms of our trade ability, our infrastructure, to really affect real economic growth going. And until you have that, then the best that the Reserve Bank can do is keep some kind of lid on inflation, but only within what it can do, really.
Chris Hattingh, thank you very much. Let's hand over to you, our audience. Do you think that prices will continue to rise? What will the South African Reserve Bank do in response? Leave your thoughts down in the comment section. Also, a quick reminder that we at the CRA release a new video every weekday morning at 6 a.m. However, we will be taking a short break on Monday the 1st. That's a public holiday. My name is David Ansara. This is the CRA. Until next time, take care.